Hi, everybody, and welcome back to yet another cracking edition of the Matt Brown Show. This is the Private Placement Perspective series where we're talking to venture capitalists, the guys that make money hand over fist, or do they? With us on the line is the general partner of Elab VC, or elabvc.com if you are interested. But his name is none other than Bob Stefanski. Bob, welcome to the show.
That's great to be here, Matt. Thanks for having me.
Awesome. So tell us a little bit about Elab VC. What are you guys up to?
We are an early stage fund focused pretty intensively on artificial intelligence, is probably the shortest way to say it. I can say it a lot longer if you'd like, but that's kind of where we're focused. And we've been focused there for many, many years.
So why AI?
Why not AI? I mean,
yeah, exactly.
AI will change the world more than any technology that has come before it. So I think it is absolutely where the world is going to be, and where it's the place to be in VC right now.
Yeah, I know, right? I couldn't agree with you more. I think so many people are underestimating this as just another thing, and for so many. Like I would say probably for 10 years, it was a thing that was coming. And then around Thanksgiving last year, suddenly it was here. And now it's like, oh shit, there's a you're like amazingly positioned, right? Because there's an explosion of attractive companies. Like you couldn't raise capital fast enough to back all the cool shit that's coming, right?
Yeah. No, it's crazy. It's crazy what's out there. And as I said, we've been at this, and you said, 10 years, that's about right. I mean, AI sort of first became a thing in the 50s, and then there were fits and starts and so forth along the way, but the technology was never there. The compute wasn't there, the data wasn't there. And then all of a sudden it happened. And about 10 years ago with ImageNet was when, deep learning broke through. And so we've been focused on it since, soon after that. But you're right. In November 30th of last year, when ChatGPT was released and the whole thing exploded on the rest of the world, was really kind of a seminal moment. It's one of those points we're going to look back in history and say, wow, I remember, I was there. What was I doing? Good time.
Yeah, it's the most exciting time, dude, I reckon. I mean, I suppose you and I will probably know this, but much of my audience probably won't. But with the dial-up modems, I remember going to London and with my first startup, which was a record label, and taking that America Online disc. And what's a disc? No, it's a thing that you put into the thing to your computer to install software. I mean, just listen to what I'm saying. And then, and then it's like, and then you had 56K.
I know, right? And you couldn't wait for it to be, 96 or 124, right?
I know, right? And then ADSL arrived. We were like, yeah. And, internet's arrived, baby. And then Facebook happened. And now it's like AI generative. Like, oh my word, where are we going, people? Super exciting there. So tell us, how did you get your start in the world of venture capital?
We started Elab about 10 years ago, a little over 10 years ago. And if I back up to, a little bit earlier, it'll sort of tell the story a little bit better. I was a, technology focused person in school. I did math as an undergrad, computer science. I did a graduate degree in computer engineering. And then I found myself in law school. And I ended up practicing what I'll just call technology law at the beginning. From there, about 25 years or so ago, I moved out here to Silicon Valley. I live in Palo Alto to start to be part of the founding team of a software company called TIBCO Software, which today is, one of the bigger enterprise software companies out there, private company owned by Vista Equity. And from there, it was, what do I do next? I've sort of done the law side of things early in my career. I've worked in, and built a software company for the biggest part of my career. And the natural next step, and to me, the most interesting next step was investing, right? And was investing in early stage technology. That's where the fun is. That's where the energy is. So that was how we got here.
Mm-hmm. Yeah, it's really interesting to hear how, general partners of VC firms actually got their start. It's super interesting. It's so dynamic, and like some were accountants, some were entrepreneurs, some, just come from all sorts of origins, and then wind up doing this, early stage investing story and doing it really well.
You bet. Yeah.
So when you cut a check, like how big is a typical check? And do your issuers need to be revenue generating, pre-revenue? Walk us through, like, where do you start?
Yeah. So like I said, we're very early stage. We are seed, even sometimes, I guess, what you call pre-seed. All these terms have changed over the last decade or so. It used to be Series A, but so we are, $2 million check. First check is probably the most typical, the average. We've done higher, we've done lower. It's very company dependent. We want there to be product market fit. We want there to be revenue, and in the significant majority of our investments, there is. But there are also companies, just based on the business model, based on the technology, that we have invested pre-revenue as well. And those are typically, honestly, big bets with world-class teams. In the AI space, that's things like AI edge chips, autonomous delivery vehicles. So, things that are going to be a longer play, longer road to revenue, but are, really, really differentiating technology.
What makes you guys different apart from like your AI specialization? Do you do like value-added investing? Do you not care? Like, walk us through, like, how are you guys different? Obviously, no capital is made equal, right?
Yeah, no, absolutely. It's a great question. And the short answer is our experience, which is of our partners, we have all founded a company. We've all got the scars from early stage startups. Two of us have had $1 billion plus exits with those companies. So we have rolled our sleeves up. We know the whole experience from beginning to end. And that's probably the biggest thing. I mean, everyone will tell you, look, we'll introduce you to, talent, employees. We'll introduce you to customers. We'll get later stage capital for you. We'll, on the exit, we've got all the connections in the bank. We have the support systems and so forth, which we do, and is all super important. But at the end of the day, especially when you are in the early stage, what really, really matters is you have the right technology, the right idea pointed in the right direction. You build the right model around it and the right team around it. And there's a lot that goes into that. And it's difficult to do if you haven't done it before. And so, I mean, Mark Zuckerberg didn't create Facebook by himself. He brought in some pretty experienced investors and some pretty experienced, management talent. And that's true for every company that's been really successful.
Have you met Peter Thiel yet?
I have not met Peter.
Do you want to?
Not particularly.
Not particularly. I've just read his book. It's enough. So quickly, the market sucks right now. Cost of capital is, a lot higher than it was. Valuations are through the floor. SVB, fallouts, exposure, dry powder, all this stuff. Seems to be like the commonality now with the market. How much do you give a shit about the macroeconomics? Do you care, or do you look? Is it a case of like, look? Yeah. You have great fundamentals, cutting edge AI applications, technology, etc. We don't care about the macroeconomics. Like, how much does this play into your decision making process when it comes to cutting checks?
Yeah, that's a great question, Matt, and a timely question. You just because of everything that's been going on, some of the stuff that you mentioned. I mean, look, you can't not care about that stuff because it impacts you, right? It impacts your fundraising ability. It impacts valuations for sure. It impacts, downstream, and it impacts exits. The market is so it does have an impact on all those things. But, when you're investing in the early stage, you're not talking about a 2 or 3 or even 5 year time frame. You're talking about a 8, 10 and beyond year time frame. So we tend to stay, we pay attention to all the macro stuff that's going on. Yeah, it's important, but that is a small part of our calculus. We are very much playing the long game. And, I will say, I said at the outset, what is happening in the world of artificial intelligence right now, and what has been unlocked, and particularly it's been put on, turbo boost since LLMs have now become the thing that they've become, the platform, the foundation model that they've become. The opportunity has never, ever been this great. It just absolutely hasn't. And so I think some of the difficulties in the macro market actually will play in the favor of, bolder investors. And it'll be helpful in the early stage because honestly, valuations will come, down to a bit more reasonable levels than they were a couple of years ago.
Bob, you are raising your second fund right now. No, second?
Third
anyway,
fund.
Third fund. Sorry, yeah. This is a behemoth thing. How does the LP, dynamic between you as a general partner and your LP network, how much does all this stink around, the markets and Silicon Valley Bank and all this stuff impact their appetite for high-risk investments like the ones that you procure?
Again, great question. It clearly impacts some of them. I think it depends on the investor. The most sophisticated investors, the ones who are, long in venture capital, the bigger institutional folks who, have been in this for a while, who understand it, are going to be less impacted by that. Honestly, they're looking at the next opportunity, and I think some of them are even, not that unhappy that that we have this environment, because I think they understand the opportunity that it presents. We have a combination, especially as a smaller fund, we have a combination of family offices and sort of high net worth individuals also as our investors. And I think it does impact some of those folks more. They've looked at their public market accounts, especially if they're in tech, just get hammered over the last year and a half. And so, I think if you're just reading the headlines, if you're seeing SVB collapse and you're seeing these things, it can't not affect you. Right. But overall, look, our funds have performed well. And if you have a track record and you've been at it and your investors know you, the impact is not that great.
Cool. Well, let's change gears for a moment, Bob, and talk about how you evaluate opportunities. So when do you decide to cut a check and when don't you? So, what do you look for? Is it the usual fundamentals like great team, TAM, product market fit, traction you mentioned, that kind of stuff, massive opportunity for growth and IPO, whatever the case might be, big problem. Is that it? Or is there something that I'm missing there?
Well, I think, you just checked a lot of the boxes there, maybe not all the boxes. And yeah, there certainly are, size of market, can it be big enough? What is the business model? What is the technology? Can it be disruptive? All those things are super important, and we look at all those things. We're really, especially when you're, again, early like us, the thing that matters the most are the entrepreneurs. There's little question about that. And anyone who tells you that they can pick a sure win or spot an entrepreneur that's going to be great, is lying. It's exceedingly hard to do. We would all make 100x in our funds if that were the case. But you can certainly eliminate, some that you can tell maybe aren't going to make it. But picking the entrepreneurs and spending the time and understanding them, understanding what drives them, understanding why they're at this place in this moment in time, and in reading that sort of passion, and are they going to be the one that is going to persist almost maniacally, who have a vision that has to be fulfilled. And, quite honestly, they have something about them, whether it's they are a world-class, AI person out of, Carnegie Mellon or Michigan or Stanford or a great place like that. Something about them that is distinctive and different, but it really comes down mostly, again, to the entrepreneur. The other things have to make sense, but it really comes down to that.
So there's two things there I wanted to double click on. So one is, I think AI is being democratized in terms of access. So there's Graft out in California. that are literally, their entire thing is around democratizing access to AI. You've got OpenAI's API platform is literally conversational, So it's kind of like, how much does deep AI knowledge really count in a democratized context for you? Because I could come to you in, I don't know, 9 months' time and go, listen, I've got an AI product. And, for you, you'd have to figure out, well, what is this? Is it just an AI call? Because, you know what I mean? Like, is it real cutting edge AI, or is it just leveraging AI's capability to create value? So where do you care at that point? Like, how much of it in the democratized context is going to change? You know what I'm saying? Like, your ability to say, like, okay, cool, put the team aside, or maybe not. Like, how does it change in the context of, well, we all have access to it now?
Yeah, even with democratized AI, the team still matters, and probably matters more, right? Because now there's less differentiation with the pure technology or whatever. But there's a lot in that question, Matt, to peel back, and that we could probably spend the rest of the day just talking about that. I will say that when you look at the way the AI is being applied in the world today, there's a lot of levels to that, right? And when you're talking about the foundation, right? And we call these things foundation models now. The ones that you're sort of talking about, OpenAI is the most well-known foundation model, but there are several out there, and the other big techs have them. Google has Bard, and Facebook has theirs, and so on and so forth. And so, with those, where you are deep AI tech, your AI credentials matter. Your AI bona fides really, really, really matter, and you want the team that can play in that game. But you're right. Once that platform, now the foundation models are now available, and you're talking about building tools on top of them. You're talking about so that so it's easier for anybody to access them. And now you're talking about building these AI enabled or LLM enabled applications on top of foundation models. Now that comes down to less. You're right. It's less the AI expertise per se at that time. It's understanding really hard problems that we haven't been able to solve before, and having the right solution to those problems, right? And you can pick almost any vertical market, almost any, and it's happening as we speak. It's shocking what's happening. I was just looking yesterday at the current Y Combinator class, and about 70% of that class is either AI DevOps, AI tools, or AI applications being built on top of these foundation models, right? So it is it's the Wild West all over again out there. And so picking those teams and the ones that are solving really hard and really important problems, those are the ones that will be really interesting.
So where does it go wrong? I mean, assuming I come to you, or whoever comes to you, these Y Combinator dudes or girls, and they try and pitch you, where does it typically go wrong? I mean, there was a interesting thing that I really subscribe to now, which is like, if a startup comes and says, cool, we're going to be $1 billion company, right, in 5 years' time, and it's AI and it's a big problem, great team, whatever. You can take those projections and divide them by 5, and then you can take their cost and double that by 2, just to kind of see, well, actually, where will they probably land up? Because I've never met a startup that's actually met its projections post raise. So, like, where does it go? Like, where do you? I mean, I'll be kind of like, is there a commonality basically? Like, where does it go wrong in the sense of, like, a founder actually coming to you and engaging with you and saying, look, I need $2 million or 10 or whatever. Where does it go wrong typically?
Yeah, hard to predict where it's going to go wrong. But it's funny. I did an investment last July. I think it closed, and the company came in about 50% over the revenue that they sold to us.
Let's get them on the show, Bob. Let's get them on the show. We have to shine a light on these people.
Right. I talked to the founder, the CEO, and I said, "Dude, what are you doing? It's awesome. No one's ever done this before, right?" So it does happen. But to your question, what are the things? I think that probably, especially in the early stage, the biggest thing is not It's seldom is it the technology per se or that the market wasn't right. It's usually not really deeply understanding what the customer really wants, and understanding, not just the market the customer's in, or it's who that user is inside the organization. Who is your buyer? Who is driving it? Who is sponsoring it? Who has to have it? Who loses their job if they don't get this? And it needs to be mission critical like that. And so you can never ever do too much customer discovery. You can never talk to too many customers or prospective customers or potential customers, because they will tell you the story. And no matter how much you imagine, you think you understand, the product and the need for the product in the market, you will always learn something a little bit different when you spend a lot of time with those customers.
So what has been your greatest success and failure, Bob, in this world of AI investing? And what would you say has made the difference?
Wow. Honestly, the success, I won't talk about. We've got some companies that are, from a return standpoint, are poised to be very, very successful. Your investors will measure it by that and so forth. But honestly, what drives me, especially at this stage of my career, is having, personal impact on people's lives, on helping people, achieve dreams, on really sort of, when things are really tough, helping them pull through with difficult times. And honestly, it gives me energy to work with younger folks, which they're usually 20 something or early 30 something founders, and add value with them. Those are the things that, when I think of, sort of what is success and what's satisfying in this business, those are very much the things that, and honestly, solving problems that make the world more efficient, make people's lives better, so, we won't invest if it's just, purely about, making money, or we invest where there can be a real positive impact on the world, because I think that goes parallel with creating value. It's part of what drives value, and so those are the things I tend to measure our success by.
I knew I liked you for a reason, Bob. Cool. But look, so listen, what is your advice then to a founder from Y Combinator, one of those 70 percentiles? And when it comes to raising venture capital today, what's your advice to them?
So it's really sort of a number of things. I mean, one, a lot of things we talked about earlier, right? I mean, your business has to make sense, right? You have to ooze, passion for what you're doing. It has to make sense why you're doing it. Be able to answer that question in spades. And honestly, be authentic, right? Tell us when you don't know. It's okay. That's like in the early stage. I mean, it is so different from even Series B, let alone, CD and beyond, and into private equity and so forth. There's so many unknowns. There's so many things that, and so, entrepreneurs that are willing to just, be authentic, to open up, to establish relationship, and to partner and listen, those are the ones that really succeed. When you're pitching a VC, I mean, don't just ask for money. I mean, tell them you want your investor to feel like they're lucky to be along for the ride, right? Like this is going to happen, right? This is I want you to be my partner because you have some value to add, not because you can just write a check, right? So yeah, there's a lot that goes into it, but don't be afraid to be authentic and create a relationship with your investors.
Yeah, such good advice. So when it comes to security structures, where do you land on things like safe notes, convertible notes, pricing the round, stuff like that? Given the fact that you sometimes do pre-seed, is it safe always? Do you it's kind of hard to value something that's not generating revenue, I suppose. But where do you fall in that whole context?
Yeah, so where what we prefer and where the market is are often two different things. In the last couple of years, so 2020, 2021 into early 2022, the safes were kind of what, especially for pre-seed, seed, founders were able to do and get away with. And if they could do an uncapped safe or uncapped convertible note, that's what they did. Mostly they were capped. We prefer equity. I mean, everybody prefers equity because you get your preferences, you get, things are established. I think you get more aligned with the entrepreneur earlier in the process. But we do all the above. If we do it's what the market sort of requires. We will advise and guide our founders on what we think is best, because we have a lot of pattern recognition. We know what happens in the next round. We know what happens in the A and the B and the C, and we know who the investors are. We know what they're looking for, and so we're trying to position 2 and 3 and 5 years out with the early rounds. And I if I had the conversation once, I had it 50 times with founders who 2021, for example, when the market's just really frothy, and they hadn't really done anything, but they wanted a $25 million valuation on the round or something with really without much at all. Like, okay, maybe you can find investors that are going to do that, because it's so frothy and people just, want in, and guess what? They've got these really big funds and they got all this money to deploy, but, it's going to come back and bite you, because now you've got, 2 million or 3 million or 5 million or whatever you manage to raise at that valuation. You're on the clock. And you've got to start hitting some milestones. You got to start hitting some numbers. If you're a SaaS company, you better have 25 customers and a couple million in ARR, and you better have, because guess what? As you move on, now everything becomes much more quantitative and less qualitative, right? And so people are going to measure on your multiples. And if you're in a particular business, everybody knows what the multiples are, and they get high and they get low and they get you are now on the clock, and you now have to meet those multiples, and you really don't want to have to go through the pain of a down round, and people don't want to invest in down rounds. It's stigmatizing. It's no, people will just move on to the next investment. So there's a lot of reasons to be smart about especially if you're going to value the company early, to value it right, so that everybody wins. And with I guess one of the benefits of a safe and of a convertible note is that you can cap it, and so it does give you some return for that risk if you're the investor. But it also sort of sends a little bit of a signal to the next the next round of investors about sort of where you think the value is, right? So I'm not sure that that's always the best thing to do either.
Yeah, absolutely. It's a bit of a minefield unless you have a VC that can actually care about what you don't know and that can paint color in the picture for you, right?
You bet. And we'll also, Matt, we'll buy common stock. We've done that to further align ourselves with founders, without the preferences and so forth. We'll buy a chunk of common stock.
So exits. A strategic acquirer comes along and goes, I like your nice shiny AI product. I'd like to solve a commercial issue or whatever the case is in our company. What happens from your perspective?
Look, this will maybe be a little bit unsatisfying to you, but those are all one-offs. They really are. I mean, what you do in any one situation is a combination of a whole bunch of parameters, right? The easy answer is, look, we're in this to build amazing, great companies with entrepreneurs that go on for years and decades, right? And change the world and do amazing things. That exit is usually ultimately an IPO, right? And so we're very patient. If it takes 10 years to get to that IPO, that's, what we're happy to do. The M&A exits, when investors come along and or a strategic comes along and wants to acquire the company, Yeah, you have to. I mean, you have fiduciary obligation to entertain those things. I mean, my starting point is typically for a company that's performing is typically, no, we're not interested. But is there an offer that, and the right strategic buyer that we would do? Sure, and we've done that. But it's very, very collaborative, and the terms are written this way. It's very collaborative with the entrepreneurs. And we have exited since we're so early and the valuations are, relatively, reasonable or lower. We have sold stock in a secondary, where the round was oversubscribed, the valuation was really good. And, maybe we wanted to hedge. We didn't have, we had some concerns around maybe where the market was or something. We've done that. It can generate as a small fund, you can generate great returns doing that. In that particular case, we were, it was a very significant return, but and that again, that's just the point that it's a one-off, right? I mean, we normally would say we would never do that, but where the opportunity is there for everyone, we do it.
Okay, cool. So let's talk about venture capital and moving forward. So what keeps you up at night, Bob, when it comes to the world of venture capital these days? Is it portfolio performance? Is it not raising enough, fund size to take advantage of like all this amazing, cool, shiny new AI stuff? What keeps you up at night?
Yeah, I've been through, so many cycles and crises and so forth out here in the Valley that I've learned a long time ago to sleep no matter what. I do understand the question. The things I worry about are they tend to be very specific with the company. You started off asking about the macro. Those are the things that, wow, when they happen, they can hit you pretty hard because they impact you so much. But I don't worry about those things. They're just beyond my control. The things that I care about most, quite honestly, are how my CEO's feeling, how my founding team's feeling, how the people are doing. Are they still energized, right? Are they getting demoralized, and what can we do to sort of help that? Those are the things when I find myself worrying about what's going on. It's 90% of the time it's those sorts of things. It's how our people are feeling and how energized, how they're performing, if they think they can make it over the next mountain. Those are probably the biggest things.
By the way, you're probably the coolest VC guy I've had on this series. I'm saying that legit because like you clearly care, and that I care a lot. And I think, I wrote my book that I wrote was called Your Inner Game. So it wasn't like how to innovate and sell shit faster. It was actually about like, listen, building businesses are very fucking hard. And, I don't think we talk about that stuff, enough, like the struggle of it. That's like, we all know it's hard, but like we all want to post rad shit on our LinkedIn profile. You know what I'm saying? And to know that your backer, your capital partner actually does care about you and your team. Like, I think that's a really different, I think you should have said that right up front. Like, what makes us different is we care.
Yeah. I mean, that sounds like a cliche, but that's something that you live, right? You live or not. And this versus, look, I'm probably different from a lot of VCs in that, I had a whole career as a big New York City lawyer. For a decade, I had, I started a company. I lived that for probably the longest chunk. And now sort of, I'm at the back end. A lot of VCs are, wicked smart guys that came out of, Stanford Business School or wherever. And really, they're great to work with and so forth, but they don't have that same experience. And they're maybe a little more transaction focused and so forth. I'm at a period, Matt, where, I kind of know what matters and I know what counts. And it's certainly not mutually exclusive to really care about the individuals and the results that they're getting, and trusting that all the other stuff is going to fall in place, as in returns and so on and so forth. I mean, not to say that you don't pay real close attention to make sure you are positioning your company and yourself and making your investment right and doing your diligence, doing all those things. Super important. You got to do those things well. at the end of the day, this business, it's not a spreadsheet business. It's a, like maybe private equity might be a little bit more of that, or, it's financial engineering, and it really, that stuff really sort of determines whether, exactly what sort of return you get. And in this business, at this stage, this is so much a people business that, you really need to be in touch with the folks you're working closely with. And quite honestly, if this is what you're doing every day, you sure as hell better enjoy it, right? You better, like being with those folks. So that's what we try to do.
All right. Well, kudos to you, man. So how do you see the world of venture capital evolving in the next 10 years? I mean, obviously AI. I mean, please can AI come and do a better job at changing the way that capital gets issued? Please, can we make it less subjective? It's kind of hard to train AI on a data that doesn't exist, but, how do you personally see, venture capital evolving in this new paradigm of business?
Yeah, there. I know you're being a little bit facetious there, but about the AI impact. But AI is going to have a big impact on how people invest, just because there is a lot more data out there. There's all the pitch books and so forth of the world have all that data, and we will get better and better at putting that into the workflow. And actually, the information will come a whole lot faster, and it'll become more predictive about sort of where markets are going to go, and and what are the differentiators that make companies successful and not. That's going to become more quantitative, more data-driven, more AI-driven than it already is. But that said, I mean, I've watched when we funded TIBCO back in the 90s. AI was at venture capital was still pretty new. I mean, there were a handful of firms, the checks were smaller, the returns were super high at that time. And, but a big fund was $200 or $300 million, right? And now we've seen this, then we went through the dry decade of the first 10 years after 2000, the dot-com implosion. And the last, 13 years or so have been just the age of mega funds and mega rounds and so forth. And my own personal opinion is, classic VC investing, where you're rolling up your sleeves and you're working with entrepreneurs and you are helping them really sort of create products and take them to market and find product market fit and really execute. Those things can only be done. You can only do that with so many companies, and they only need so much money. So the math with a multi-billion-dollar venture capital fund is really, really hard. You can't really do early stage investing with those kind of funds. And so, you need to be really late, and you need to place sort of really big bets later. So we've seen a lot of those bigger funds come back down into the earlier stages and try to anoint winners with these massive, early rounds before they've done anything. We'll see how that goes. I don't know that that's necessarily going to win. If I were to predict, I would say we'll probably see a little bit less of that going forward, because there already are some notable failures of these massive checks too early. But I think we'll probably see a few more of those. But I think hopefully, venture will continue to, be a bigger and bigger part of the economy, because if it is, that means we're all winning. It means a lot of value is being created. It means a lot of new technologies are being brought to market. It means people's lives are getting better, right? I mean, at the end of the day, that's what I would hope for.
Mm. Well, we shall see, right? Hindsight's always a perfect science these days, apparently.
Yeah. Exactly.
So let's wrap this one up. Bob, if you could get into the Matt Brown Show time machine and kind of go back, when you were my age, and give yourself a piece of advice, right, about venture stage investing, what advice would you give yourself and why?
Honestly, I'm not one to go back and second guess a whole lot. So I'm not going to say, gee, I was so dumb about this or so dumb about that. I will say that you learn a million things. So it wouldn't just be one thing. There's a whole bunch of things that you learn along the way that you try not to you try not to do again. But it's really hard to point. It's really hard to point to one thing. I would say if I could just focus on a couple, I'd say, really understand when you make your investment, what that exit is likely to look like, who it is, and who are the investors that are going to want to invest in, this company, this technology, this market. Specifically who they are, not just the firm, but the person, right? In a lot of cases, and talk to them, and and really sort of understand the entire path, as opposed to wishful thinking, where you invest because it looks really cool and I imagine it's going to be really great, but it's not really clear who's going to acquire this company down the road, because it doesn't really fit well with anyone. So that's one area where I'd say, everybody sort of learns, and you fill in the data points so that you make sure from day one, when you're investing, you are working with the entrepreneur to build the right model, to hire the right team, to get to hit milestones, be really clear about what those milestones need to be for you to be successful, and I think that's something that that you can only get better at by having done it for a period of time, right? And really sort of understanding. But also, I guess another thing, Matt, I would say, understand, be very tightly focused. There's two broad ways to invest in venture capital. One, you can spray and pray, right? And you can just write a whole bunch of checks across a whole bunch of things. And there are some very successful, early stage, pre-seed, seed stage outfits that do that just kind of work into the right networks. Maybe they focus on Y Combinator or a couple of other things, and they write a whole bunch of, $250,000 checks, and they hit a couple, and boom, they're great. The other way to do it is to roll your sleeves way up, place fewer bets, but really, really have a thesis, and really, really understand the markets you're going after and the technologies that you're going after, and do those really, really well. And we're sort of in that later category. So I'd say, do your homework and understand the technology and the markets that you're investing in really, really well.
Does that thesis also differentiate you then in terms of raising a fund? You know what I'm saying? Like, if you have this very specialist, in-depth, we really know what this is about, this is exactly who we want, this is how we approach thinking about an exit before we cut the check, and all that kind of stuff. Does that actually play a positive role? Does it contribute in your ability to raise a fund 3, for instance?
Yeah, oh, absolutely. Absolutely. I mean, look, the most important thing by far is track record. Everybody's going to look at, okay, who'd you invest in? What'd you do? How are they doing? That matters the most. But I mean, any LP, especially, the institutional guys that do this for a living, will tell you, the story really needs to make sense and hold together, like right now, today. So many people come in and say the same thing, or well, we're a SaaS investor, right? And we really focus on this, and we're going to invest, only when the company hits, $2 million in ARR, and we're going to have, and their CAC's going to be this, and they're going to, all these things. And that's all good. You should do those things. You should have those kind of metrics. I think that's how I would look at it.
Awesome stuff. Well, Bob, that concludes your time in the hot seat. Thank you for lending your perspective on the private placement perspective series here on the Matt Brown Show. You're a cool cat doing amazing things. Timing, I'm a great believer of, and you guys are poised to really make a killing. So, and also to make a difference. I think, as you said, these technologies truly are going to change everything. And to be thinking the way that you're thinking philosophically and having the track record that you guys have had to date, it's going to be a bright future for you, I'm sure.
We hope so, Matt. It's been my pleasure. I appreciate you having me on.
Anytime. Thanks, everybody.